Hello， 大家好，欢迎回到北美韭菜日记，我是九九。2023年开年以来呢，股市币市也都算是开了一个好头，才半个月的时间，道指上涨了 3.5%， 标普上涨了 4.5%， 纳指上涨了 6.6%。币圈这边呢，也算是迎来了一轮小行情，比特币、以太坊从最低点分别是反弹了 30% 到 35%， 年初至今则上涨了 20% 有余。虽然说2023是开了个好年，相信各位朋友的账户里最近也是没少回血，但是从我这边感受到的散户的情绪似乎并没有回来太多，反而是看空的占大多数。这是我在上周 CPI 公布的那天收集的一轮投票， 42% 的朋友觉得 CPI 数据算是利好出尽变利空该跌了，只有 24% 的朋友认为是利空出尽变利好该涨了。看空的人数几乎是要2倍于看多的人数。当然了，从逻辑角度去分析的话，现在市场上的确是坏消息占了大多数。通胀虽然说有可能要见顶，但美联储目前并未表现出有转鸽的迹象，口气依然是非常的强硬。这个月月底的 FOMC 议息会议十分关键。另外，从历史数据去看的话，美联储最终能够实现软着陆的次数也是少之又少，大多数情况都是在对抗经济过热的时候过度紧缩，然后把经济带入衰退。因为如果经济不出现问题的话，理论上来讲，美联储就没有必要去放宽政策，他们巴不得是维持在一个高息的环境，借此来减少高居不下的资产负债表里的债务。所以对他们比较有利的情况，肯定是降息的事情能拖多久就拖多久，除非刀架在脖子上不得不降了。但是真要到了那个时候，市场可能又会担心经济衰退是不是太过严重了，美联储还有没有能力把经济盘活等等。之前也是给大家看过一张图，历史上大多数股市真正开始进入最后一阶段崩盘的时候，往往就是美联储开始宣布要降息的时候。所以从这个角度去看的话呢，看空的朋友们现在谨慎一些也没有什么毛病的，逻辑上来讲的话也算是比较能自洽。但是现在的问题是，市场的走势似乎不太认同这样的逻辑。过去1年多的大熊市里，我学到的很深刻的一课就是，永远不要想着去教育市场，这样想的人最终都会被市场所教育，还是要懂得敬畏市场。回想起1年多以前喊着教育市场的我，也是非常的幼稚。想一下，因为既然说我参与到了股市里，那就肯定的按照人家的规矩来。就好比说我进了赌场，赌输了2把，就吵着闹着说是赌场的规矩定的不合理，那不被赌场的人按在地上毒打一顿，也算是奇了怪了。所以说在这个时候呢，虽然目前我对于今年的整体局势依旧维持谨慎态度，但是当看空的观点已经成为了大多数散户朋友们的共识，而市场却一路高歌猛进的时候，我觉得还是非常有必要来听一听有一些刺耳的看多的声音的。所以有请今天本期视频的嘉宾 Tom Lee， 他预测美股大盘在2023年会有 20% 的涨幅，而纳斯达克涨幅他预测更是有可能高达 50%。在进入采访视频之前呢，首先感谢一下富途moomoo对于本期视频的大力支持。moomoo是富途牛牛海外版，全球近2000万用户。这里重点给大家推荐一下富途这边的经济日历和财报日历这2个功能，对于咱们股民朋友们来说呢是非常有帮助的。通过使用富途的经济日历功能，咱们可以及时掌握全球的重要经济数据，例如一键查看彭博对于美国通胀数据的预测、美联储加息数据等，历史数据的前值、预测值、公布值一目了然，同时具备筛选功能、重要经济事件一键设置提醒功能等。在快讯栏里也可以查看7×24小时的全球实时资讯。另外，下个月也即将进入美股的财报季了，相信老股民都知道，财报对股价的影响也是非常重要的。能否准确读懂财报，也是后续把握股价走势的关键。富途moomoo为广大观众贴心的准备了财报日历及追踪功能，可了解未来1个月内发布财报的公司，同时还有业绩解读功能，对已经公布财报公司的数据的详细解读。以上这些功能也是完全免费开放给所有股民朋友们的，新用户还可以免费领取新年投资秘籍加上 APPLE 等16股免费赠股，需要的朋友们可以点击视频下方或评论区置顶链接加入领取。OK， 那么话不多说，一起进入采访视频环节，来看看 Tom Lee 是怎么说的。翻译加字幕这个工作呢，属于纯体力劳动，觉得有帮助的朋友们还是拜托可以留下一个赞好。听完之后，不管你是否同意 Tom Lee 的看法，也欢迎你在评论区里各抒己见，表达自己的看法。
Back in overtime, stocks off to a strong start this year, and my next guest calls this, quote, Strong omen for the market. See stocks rallying 20% this year. Joining me now right here, Post 9, CNBC contributor Tom Lee of Fundstrat Global Advisors. Happy New Year. It's good to see you. Welcome back.
Great to see you, Scott.
So you were admittedly too bullish last year.
Yes.
You are, in a sense, doubling down on that. 20%? How?
Yes. Last year was a year where inflation shocked the markets in the first half. It's come off the boil since October, very soft. I mean, if December comes in the way we think, it's probably 2.6 annualized inflation now. And wages are coming off the boil, right? If we look at the employment report Friday, they're growing at 3.7, which is where they were before the pandemic. So the third thing that we think needs to happen is volatility needs to come down in the VIX. The bond market volatility is below its 200-day. If that happened in the VIX, we'd be at 17. And since 1950, following a negative year, if the VIX is lower on average than the prior year, we're up an average of 22%. So I think we're set up for a 20% year.
Even with the Fed speak, if it's not Kashkari, it's Esther George. If it's not Esther George, it's Bostic. Just to make, sure Bostic got his message across. He spoke late last week. He spoke again before the show today. I mean, these guys are talking and women are talking tough.
Yes, they're talking tough because they want financial conditions to stay tight. That's dollar, stocks, bonds. Everything's kind of easing, so they're probably a little worried, and they want to be sure inflation is, in fact, dead. But I think one of the changes, especially since October, is that inflation's been undershooting. This Thursday will be very telling, but if CPI comes in at 0.2 core, below consensus again, that means the Fed's original projection of 4.8 on the PCE is 60 basis points too high, translating that over. And that means inflation is undershooting by a huge margin. The bond market is going to push the Fed to say February might be the last hike, and then after that is cuts.
I mean, but the Fed members themselves are not, drinking what the bond market's serving up, right? They keep talking as if they're, as I used the word with Leisman a little while ago, hell-bent on getting to that plus 5%, however much over 5% we can argue about, and then staying there for a while.
Yeah, I think that's because part of the Fed model is they're using a Phillips curve. And at the moment, they're focused on this services number, ex-housing, which has been inflationary, and their view is that it's driven by wages. But what is sort of not being captured at the moment is the goods have dropped so much, and wage inflation slowing, and housing, especially this week, looks like it's actually come off sharply, that the trajectory for core could be, we could be sort of annualizing close to 1% in the first half, and that's far below what the Fed. I think at that point, the Fed would have to sort of rethink its reaction function.
So what happens if they, I'll grant you, let's say they pause, right, but they don't cut? How much do you need a cut to get your 20%?
I don't even think the Fed would even have to cut, because once they pause, which is now, the Fed went from 5.1's the terminal rate to we're pausing at 4.75, it raises the bar for them to start hiking again. So I think that the bond market would interpret that as the start of a cutting cycle. I think rates would come down. Of course, this will worry the Fed. That's why we're hearing tough talk. But if inflation data comes in soft, I think everyone's going to be on the same page.
So a pause alone is enough for a huge rally in stocks?
Yes. Yeah, in fact, I know folks talk about earnings could be down this year, which I think is a possibility, but...
Well, is it a probability or a possibility?
I think it's only a possibility, because the dollar falling is a tailwind for earnings. And but if earnings are down since 1950, it has not been an important factor for if stocks go up or down. So it's volatility, the VIX is a much more influential factor.
Do you think the market's going to overlook the fact if earnings come in even lower than where projections have re-rated them to already? Markets going to overlook that?
Yeah. In fact, I think that's, we can look at it even just now. Tesla missed on delivery numbers. It's at 120 now. I mean, I think stocks are already showing you that you could have bad news, but if it's priced in...
Well, I mean, we're going to use Tesla as the litmus test. I mean, that stock's already gotten from a multiple of 80-something, all the way down to 20.
That's kind of why it's interesting. If you look at what's correlated to financial conditions easing, it's tech, discretionary, and industrials. These have been doing well. They're kind of telling us financial conditions will ease. But also, these stocks shouldn't go up if earnings are, these should be the ones getting hit by earnings, and they're going up.
What about tech? It remains the biggest, I don't even know if I should say biggest question mark, because it seems like the questions have been answered. The stocks were overvalued. Even the mega cap stocks that deserve to have a premium valuation don't necessarily deserve the premium that they even still have now, which has been compressed as well.
That's right. Tech's been a darling. It was over-owned. They got expensive. Now people think that they're going to derate forever, but we know that if the market is bottomed in October, tech has always led off a bottom. Tech is also how you cure inflation, because that's how you reduce wage pressures. And if the multiples have come in and financial conditions ease and rates fall, then multiples should go up. So tech has tailwinds this year that didn't exist last year.
Do you think the worst is over for, and let's separate the baskets of tech. Massive multiple once to FANGs, the mega caps, which, most of them, I think we would suggest their multiples weren't nearly as egregious as some of the others. Do you think the mega caps, the Apples, the Microsofts, et cetera, have they corrected enough?
Yes, I do, because I think that their shareholder base includes a lot of people who have huge capital gains, aren't going to sell because of a miss, but a lot of those who had to get out because of performance issues have sold. So I think tech can get new ownership. And that's what's going to help them. On the mega cap, on the hyper growth stocks, if rates fall, it's going to help them. So I think that they can bounce, but they're not the ones that make this a good year for stocks. What's going to make this a good year for stocks is industrials, discretionary tech. And I think that it's going to feel better as we go through this year if inflation continues to undershoot.
What's your most favorite sector right now?
Well, I think FANG might be the easiest buy just because nobody really thinks it can do well, and of course, if FANG rallies, that's going to almost drive the 20% gains.
Easier than, say, a financials or a healthcare or an energy where, a lot of the smart money has been going?
Energy, we've liked it since 2020.
Alleged.
And
alleged smart money.
Yeah, and, I think it's going to re-rate, but the challenge is it's still got a geopolitical element to it. Healthcare, I think, is a good GARPy group, but it's not something that can be up 50%. FANG could be up 50% this year.
So you're thinking that 50%?
Possibly, yeah.
50.
Yeah.
So the Nasdaq's going to have that great. So if the S&P is going to be up 20%, what's the Nasdaq going to be up?
It's well over 20. Scott, I just say that the first 5 days is a pretty indicative of how markets go for the year. In fact, of all the instances where you had a negative prior year, and then you're up the first 5 days, okay? That's 85% of the outcomes had positive gains for the rest of the year, averaging 20%. The only two exceptions was 1970 and 02. So maybe if you think this is 02 when we have a lot of trouble ahead, but if it's not 02, then you have an 85% probability it's a 20% year.
Well, you set the bar this high at the beginning of the year, Tom. There's little wiggle room now. You got to get there.
All right, so I'll just have to come back on December 31.
You'll be back many times between now and then, I hope. Thank you for being here.
Yeah, thanks, Scott.
All right, that's Fund Strat's Tom Lee with us here at Post 9.